investment can be a risky business, but to give us his insight into risk management is Tal Shir from Geneva Investment Partners. Welcome.
Hi Alex, thank you for having me again.
Well, thank you for coming. So how can risk management improve the chance of an investor making money in the long term?
Okay, so basically it's a well-known fact that investors are often irrational in their behavior. They will be looking to invest in terms or in instruments that are showing a positive momentum, and will often go out or disinvest once volatility is becoming big and they can't suffer this volatility anymore. So when we look, for example, on the US equity markets, one can say, why not just hold an S&P and stay there all along, because I'll make money over the long run. The question is, will you be able to hold it? Will you have the guts, in a way, to keep holding this instrument when you're suffering a drawdown of 50% or 60%? So there was a famous value investor, Benjamin Graham, that says an investor that can't control his emotion is ill-suited to benefit from the investment process. And you can show the graph that I've prepared. I found it on the website of Davis Advisors. And this guy basically made a research showing that the difference between the performance of a fund or the equity market is very far from the performance that an investor is gaining. And they call it the investor behavior penalty. What's happening is investors showing a fund or an instrument or a market that goes higher. They'll put their money in, and once this market will correct, they will go out. And at the end of that, they will be penalized by this in and out investment that will reduce the long-term behavior. What we try to do in Lake Geneva is to help investors mitigate this problem. And to mitigate this problem, we believe that a portfolio needs to have a constant level of risk. By having a constant level of risk, investors will have less tendency to make irrational decisions, and will, as far as they know that the risk is constant, even if the portfolio doesn't perform very well for a certain period, they won't rush into taking their money out and maybe losing a potential gain or taking the money out at the bottom, as they often used to do.
So you're telling investors to just calm a little bit?
Yeah, exactly. So it's making them calm, it's making them feel safer, and it avoiding them doing this irrational behavior that a normal investor will do. I hear people like talking today saying, why not just holding a bunch of ETFs and follow the market? It's good, it worked well since 2008, but will you be able to hold this portfolio when the next correction comes?
So tell me, how do you generate long-term returns?
Okay, so we're trying to be as diversified as possible. We're not betting on big macro terms. We don't know what the market will do tomorrow or in next year or in 5 years. So we have various systems or various machines, we can call them, that has the potential of generating positive return over the long term. And by having all this machine working simultaneously, and all this wrapped in a strict risk management system, we hope and we think, and historically that's what happened, to generate return over the long run and to prevent our investor from having significant drawdowns. We can tell which term of investment is going to work in the future. So if you look on value investment, for example, this type of investment have been generating long-term return and often outperform the market over the long run. But if you look at the dot-com bubble, the value investment largely underperformed the growth investment. When interest rate will eventually go higher, there is a good chance that people will be less looking for yield and we look for growth. We don't want to bet on a single macro event. Okay, we would like to have a diversified portfolio that we believe that will generate the alpha that we're looking over the long run.
So finally, what makes you as a manager unique?
Okay, so like I mentioned before at the beginning of our talk, many people think now that just by buying an ETF, a simple strategy, they will be able to outperform all the universe. If you show the other graph I brought in, you can see that basically equity here, this is in this specific graph, it's equity hedge fund, has continuously over the years underperformed the index, especially when we come into the last 5 years. So on the top of that, their correlation to the market became bigger. So managers are kind of squeezed into getting more and more risk into their portfolio and take off the hedges of their portfolio, because people are expecting them to perform as good as the index and to protect them when they can. We think that at a certain point in the future, it can happen tomorrow or in 5 years, volatility will pick up again, and the people that will be well positioned and the investors that will be well positioned will be the big winner in this situation, and we hope to be one of them.
Thank you for coming in today.
Thank you for having me.
So that's all we have time for, but if you have chosen a risky investment, make sure you stay for the long run. Check back in with Dukascopy TV for more updates on the market. Goodbye.